everyone, and welcome to one of our knowledge transfer sessions. Today we're actually closing out our videos on the annuity series with the last style of annuity to talk about, the registered index-linked annuity, or RILA. I like to call it the new kid on the block. So this is the last of our videos of these knowledge transfer sessions around annuities. And then from this we'll go back to more standard financial planning and tax analysis and asset allocation videos. As with always, whenever we do these videos, we have to treat them as general in nature. We're trying to summarize lots of information as fairly as possible, but things can definitely get lost, and everyone's financial situation could be different. So we have to treat presentations as general in nature. A little bit about myself. My practice is next to Overlake Hospital in Bellevue, Washington State. I have more than 18 years experience in the financial services industry. I've worked everywhere from a bank to selling mutual funds, to selling annuities, and even these things called RILAs today. So a good well-rounded background to kind of give these videos for you. So what we're going to talk about today is we're going to talk about what is a RILA, or a registered index-linked annuity. And I'm going to just shorten that to RILA for the rest of this presentation. But what is this? Because this is the new kid on the block. Then we're going to talk about the basics of the interest rate calculation. Then we're going to talk about what are the fees. And then we'll just kind of close out with more of a discussion around, is this a good idea or not? And so let's talk about the basic idea of understanding the RILA. So first thing, when we talk about the word annuity, as I made a video that you have no idea what the word annuity means, the word annuity means all sorts of different products and concepts. And when you add riders onto the products, it can fundamentally change the product even from there. So the word annuity is meaningless. But if you use the word RILA, anyone who knows anything about annuities in the financial services industry should know what you're talking about. And if they don't, they probably don't understand annuities that well. They might understand an annuity or a style, but actually not understand the overall products that are out there. And the thing about the RILA is annuities, even the word annuity goes back to Roman times. Annuities, the concept of them have been around a long time. Specific subtypes, remember, the word is meaningless. But RILAs are the new kid on the block. I mean, it created in the last 15 years. They were an attempt by the insurance companies to adjust to a low interest rate environment and an environment where things like the S&P 500 have been a dominant investment force for 20 plus years at this point. And they needed a product that could compete in this space. And they came up with the RILA as this should work if all these other things continue, like the S&P 500 being dominant. And so when we talk about the RILA, RILAs and most indexing strategies are going to be based around an index, like the S&P 500. That's how it's going to track and make interest. And like kind of like a variable annuity, right? You can't guarantee what the interest is going to be. It's an interest calculation. So where if you buy a CD or a fixed annuity, you might be getting 4 or 5% guaranteed interest on an annual basis. This isn't guaranteeing the interest. It's going to fluctuate up or down with the market. But on the other side of the equation, if the market crashes, this is going to give protections. So it's a lot like a fixed index linked annuity, except unlike a fixed index annuity, your loss, you can actually have losses with a RILA. It's one of the insurance products that does allow losses to occur under certain circumstances. But it is considered lower risk. So you're trying to get potential gain from market growth with low risk is the idea. And there are two really big subtypes of these products, commissionable and advisory-based. Advisory-based is where you can hire a financial planner for like a flat fee, and they could open one of these products for you, or they can charge 0.5% to 1% on the assets to manage this bucket for you, or you can buy this from someone and they're going to earn a commission behind the scenes. And there's actually some nuances to the product based upon which route you choose. And the thing about a registered index annuity, a RILA, is one of the biggest challenges here is you have to understand what's called how they protect you from the downside risk. And so when we talk about the interest calculation, there's this thing of understanding how it's supposed to protect you. And there's really two terms you have to understand, a buffer or a floor, okay? A buffer basically says we're going to eat the first percentage of loss, like say 10%. And then after that, you're going to start taking losses again. So it's a good way to mitigate some of your potential risk in, say, the S&P 500 by saying, you know what, if it goes down 10%, I don't want to take you those losses. If it goes down 20, okay, I'll take half of that, which is really good actually, but I want to absorb the first 10%. A floor actually cuts your absolute risk. So what a floor does is it says, if the market goes down 8, I'm going to lose 8%. But once it goes down 10%, I stop my losses at that point. So a floor caps your losses, and it's actually less popular than the buffer typically. But a floor, like if the market crashes 30%, the buffer is technically worse in this example because you take a 20% loss, and the floor you'd only take a 10% loss. And one of the nice things about these products is, unlike most annuities, you can actually go out there and find rates. You can find product information. You can find prospectuses. Here's Nationwide's. I went out there and grabbed this myself. And so unlike most annuities out there, you can actually find product information readily available. And that's great because that lets you research this yourself and decide, is this something I might want to go down or not? And I find with people having the ability to do more and more financial services themselves, this is a pretty powerful element, I would argue. But when we talk about this product right here, there's a specific sales pitch around the RILA. It's, I want investment growth. I want my money to grow. I want to protect against market risk. And I want that money to come out some way, right? I want to provide for loved ones or whatever I choose to do, provide for myself, in fact. And so when we take that basic sales pitch that you can go find on multiple brochures and multiple products, we have to explore, does this actually track the performance of an index? What's my give and take here? We have to understand how the downside protection works. This idea of protecting loved ones, like how do I get my money out? And, is this like those other types of annuities where I'm locking my money up for a period of time? And so one of the most important things to understand this product is the interest rate calculation. And it's a little more complicated, actually. This is a more sophisticated form of investment. And so when we look at the interest rate calculation, when we always have to remember some basic rules about annuities, okay? And this is true across the entire spectrum. They're tax deferred until withdrawn, typically. When you withdraw money, the first money that comes out is the interest, so it's taxable immediately on those first dollars that come out, but not your principal, depending upon the type of funding. They're usually income taxable at death, meaning they don't get the step-up in basis. And if you take them early, you can have a 10% tax penalty on the interest. So there's a little bit of gating around ages on these. And so once again, using that Nationwide product that you can go look at yourself, we can start to see how the interest rate calculations work. And let me walk you through all of this right here. So one of the first things you have to decide is the trade-off between how much protection do I want versus how much rate of return do I want. So these are buffers. Remember, a buffer means that they're going to eat the first percentage of loss, so in this case 10 or 20%. And then after that, that's when you start taking losses. And then you have to look at how long you want your rate guarantee to last for. So some of these products have no surrender schedule. Some of them might be 6-year products, basically. But within that, you have to decide, well, do I want to deploy $100,000 on a 1-year bucket, a 3-year bucket, or even a 6-year bucket? Just lock it in for all 6 years. And there's interesting things that happen on each of these scenarios here. And this is where people, like when you first look at these, you're like, oh, I don't know if I want to understand these. They look complicated. And then you see this and you kind of go, that's interesting. And I think it is interesting. So let's use the S&P 500 and we'll just focus on that one for right now. And we'll use the 10% buffer to start with. So if you have a 12% loss, you know that you would lose 2% of your money, right? Because they're going to eat the first 10%. The 1 year, you can get up to 18% of the market return at 100%. So if the market goes up 18, you make 18. If it goes up 16, you make 16. If it goes down -8, you just don't make any interest during that time segment. That's kind of interesting. Okay, so I get up to 18% of the market. So if it grows 30%, there's clearly some negative there. But if I buy the 33-year bucket, I can get 85% of the market returns. And if I buy the 6-year bucket, I actually get full market returns at a faster rate because the participation rate in this example is 105%. So if the market goes up 100, you make 105, okay, on the 6-year bucket. So you are locking up your money, but it actually is tracking the performance of an index pretty fairly in here, actually, if you look at this. And so I would argue that this part is actually fairly true. You don't have the absolute guarantees of, say, an indexed annuity, a fixed index annuity, where you're totally protected from market losses, but you are getting the upside in a way that those never can reasonably match. And so just to simplify this, if you buy that 1 year bucket, if the market goes up 15, you make 15 because your cap is 18%. If the market goes up 4, you make 4. If the market goes down 20, you lose 10% of your value. There is one other thing to mention on these interest rates. Most of these products have a lock-in feature, which means that in between your year, so like let's say you buy a 1 year bucket or a 3 year bucket, and let's say you've only made it halfway through, but you're already maxed out like the 18%. Well, most of these products will have some form of lockup where you can take most of those gains and just bank them and never have to worry about the market crashing out down the road. So it's kind of a nice little interim feature to lock in gains if you've already hit your numbers, basically. You still have to watch out for options repricing. I really hammered fixed index annuities on this, but just recognize like some of these contracts have no surrender charges, meaning you buy a 1 year product, you get out after 1 year, or even technically earlier. But some of them say have 6 year surrender schedules, meaning if you get out early, it's going to really hurt. And what happens here is that one of the problems you can run into is you buy a 1 year bucket, but you're in the contract for 6 years. And in the future, that bucket's just going to be repriced based upon the options market. The insurance company usually doesn't try and hose you on these. Most of the time I see what's called a renewal rate history for these products, meaning they're really aggressively trying to show they're not trying to hose the average consumer. Insurance companies do hose people all the time, but I would argue in the realm of understanding insurance, it's not happening as much here. Okay, but you still have the basic problem that the cost of options can change year by year, which means their costs change by year, and they can fundamentally change that 18% cap rate to say 9% cap rate in the future, because that's what the market is saying they can do based upon the calculations. So I would just watch out for your intervals. That's why 1, 3, 6 blending all those can be a really good idea, as opposed to just buying 1 year or 6 year. So I think when you first look at the interest on this, it's pretty compelling, honestly. It's not going to beat the market, right? You're almost always getting less than market returns here, but you are getting good returns, potentially. So what are the downsides? What are the fees? And so these are the 3 main areas you're going to run into for fees for these products. The first is going to be commissionable versus advisory fee. Most of the time, you don't pay the commission. It's paid behind the scenes. But the insurance company is then going to lock up your money for a period of years, like 6 years. Okay? An advisory fee is when you're paying someone like me 0.5% to 1% or a flat fee to open this account on your behalf under an advisory agreement, basically. Because unfortunately, still buying insurance company products directly is still kind of hard. And so when you pay these advisory fees, every year on the contract, you're paying this fee out, basically. And that would be a fee that comes out. You can also add all sorts of riders to these contracts. I grabbed this from the Nationwide contract. This is an optional return of premium rider that you can add that they charge an extra cost for you to add. So even though you might be earning, say, 8% interest, you're going to lose these costs in here. So when you first look at this right here, you might go, well, the commission option is better than the advisory, because you're not being charged the commission. It's just locking up your money for 6 years, and the advisory doesn't typically lock up your money, but you're paying these fees along the way. I would argue the advisory is actually much better. And the reason is, and this is a conflict of interest because I earn advisory fees, but here's why. When you look at these products, and when you go to one company and they have both advisory and commissionable products, so basically the exact same product, one they're offering the ability to sell it as a commission with a surrender schedule, one they're saying no commission, and the advisor and client can agree to any fee schedule they want. Well, because they're not having to pay a commission, they're able to then take that money they'd be paying in commission and put it to the rate equation. And that rate equation, I just used one company. I went to one company immediately. That's an extra 3% in cap rate, which means when the market pops, you make an extra 3% money every time that occurs. And that starts to get really interesting, and there's all sorts of ways that can work. And so what I typically find is you actually make a little bit more interest under the advisory product. But then you get a secondary feature that's even better. Advisory contracts don't typically have surrender schedules. You want to buy this for 1 year? Great. You buy this for 1 year, you do your interest calculation, you get out. You want to buy this for 3 years? Great. You maybe blend 1 and 3 year interest calculations, you buy it, you get out. You see how your ability to just cash out whenever you want because you're in an advisory contract frees you up to make all sorts of other financial situations that being locked in under a 6-year surrender schedule doesn't let you do. Advisory contracts are probably better, not just because they make a little bit more interest, but because they typically don't actually lock up your money. But you do have to pay those advisory charges, right? So you have to go, well, okay, I get this, but I'm going to have to pay these fees, and you have to find an advisor to open this contract for you, because right now there's not, I don't really see an easy way for someone to do this without being an advisor today. Things change, though. So is this a good idea? Once again, not perfect. There's no perfect product in the financial services industry. This is complicated, right? We're talking about options pricing. We're talking about buffers, floors, cap rates, participation rates, multiple different types of indexes. It's a lot harder than buying an S&P 500 fund, right? But it's not not understandable. But a lot of times when I advise it to someone, they're just trusting me. They can't understand all the nuances, the trade-offs they're making behind the scenes, things of that nature. This also isn't an absolute guarantee. All right, you can take losses, right? If you have a floor of 10% and the market goes down 20, you take half the loss. That's probably really good, but some people just emotionally never, ever, ever want to see their money potentially go down. This also needs to fit your goals, right? The S&P 500 is liquid. It should return slightly better returns than this, right? So you just buying the straight index might just fit your goals a lot better. And depending upon your just investing capability, right, you could buy gold at the exact right time. You look at gold or silver, what it's doing right now, crypto at the right time. Like there are other things you could have invested in that probably have much more risk, but have potentially very greater returns. And then the last one's a little tougher. Like you do typically need to interact with a financial professional by one of these. And once again, that's that problem of you want to do things yourself, you want to research this, you want to feel comfortable at your financial plan, and then you got to talk to someone who might give you a sales pitch. All right, that is a negative. But there are positives here, and this is why I actually really like these products, even though I don't use them very often. Because there's always this basic problem of what's your plan to deal with indexing risk, right? So if we say indexes are really good investments that over the long term typically outperform a lot of advisors or other situations, you always have this basic problem of, well, it is technically considered aggressive. It does have max drawdowns of almost 25% in the last 10 years. I mean, that's how much it went down one time in the last 10 years. The rate of return fluctuates, 15.5% up or down, right? So you can get 28% or -2 pretty easily. And so, the market is more volatile. So what's your plan? Like, do you have a really good pension and Social Security income and you could just ignore this? Like, do you have a paycheck and you could just ignore this risk? Or do you need a plan to deal with this risk? And the way the market deals with risk in the consumer space is not really that good. It's okay, right? Sometimes things can be just okay and that works, but not good. And so, you look at bond funds and how index funds, target date funds use bond funds, and bond funds are just anemic as the rates of return. You look at high yield money market accounts, which have been great recently. But if interest rates go lower, these immediately crash, right? So you don't have a long-term high interest rate potential here is the problem. And then we look at, say, individual bonds, individual CDs, treasuries of different durations. And I got this from Schwab back in June. You see that the rates of return are okay, but not great. And you also see this weird thing where we kind of still have this not quite inverse yield curve, but to get better rates, you have to lock up your money for like a really long time. And it's not that much better than the short duration rates for how long you're locking it up. Right, so this exists in this space here of It's probably better in a lot of situations than a lot of other fixed income alternatives, like a bond fund, but it isn't perfect. Like and it's not it may not meet your goals. So because of this, we suggest we prefer process and not product, right? But this is not a terrible thing to look at as part of your process. A well-rounded plan that explores this and other options are a preference because it needs to fit in your goals. And don't ignore these as bond alternatives, RILAs, FIAs, any of these indexing products as bond alternatives, because they have some strengths as long as the S&P 500 keeps going as it's going, that bond funds don't have. Don't ignore tax deferral as part of a tax bracket strategy here. You do get to tax defer these returns, which allows you to take advantage of the peaks and valleys in retirement. And then just recognize, we own a brokerage agency here, and we get to see all sorts of different insurance products and comparison shop this, right? Because the difference between two companies can be thousands of dollars or tens of thousands of dollars in your favor. So we're here to help, and we really appreciate getting to put these videos out here. Our practice is based in Bellevue, Washington State, so most of our content's based here. But if you ever have questions, feel free to reach out to us down the road. We'd love to talk to people, love to give ideas or just transfer knowledge back and forth. So I hope this was helpful, and we're going to move on to some more market-based or some other types of concepts we're going to be talking about that won't be annuity conversations. So this is the last of our annuity videos, and we hope it was helpful for you.